those things to be able to increase the tax effectiveness of wealth transfer. So let's look at your second generation. There's three things that I would argue are most important for equipping the second generation: education, opportunity, and relationships. It's these three things that a parent can give a child more than money, significantly more than money, that's going to equip that child or grandchild to thrive and experience financial freedom and financial independence no matter what circumstances they face. In the education arena, there are two things. There's academic education and life skills. And one technique, I've worked with a number of clients that actually kind of meets both. We'll talk a little bit more in the future about, but there's Coverdell savings accounts, and then also purchasing real estate through your gift exclusion, roughly $20,000 per person per year, or sorry, $13,500 per person per year, gifting real estate over, and kind of like how Sean, the president of our company, learned, his father bought him a property at 10, and he learned to manage it, and it gave him, it's that old parable, give a man a fish and he'll eat for a day, teach him to fish and he'll eat for a lifetime. Real estate can really be used to teach actually a number of incredibly important life skills: financial management, people management, dealing with tenants, bookkeeping, and also how to be able to generate cash flow and income. So a lot of people are reticent to get their children involved in their investment portfolios, but I'm personally an advocate. Start early, letting them make basic and simple decisions so that they can start to learn the skills and eventually transfer responsibility and ownership to your children. I think I'd mentioned at the beginning of this webinar that I bought my first property at 18. And of course, at the same time, the college savings that we had in Enron stock obliterated, and my father had made too much money the year before to be able to really even have FAFSA take a look at my, academic credit application. So I was facing very, very high student loans and no real family income at that point. The income from my rental property covered my monthly expenses, and I started to pay, instead of letting my interest accrue every year on my student loans, I was actually paying every year down the interest so that when I graduated I didn't have as much debt. My property was paying for that for me. That's invaluable. In a more technical capacity, you can actually have what's called a Coverdell savings account. It doesn't have a very high contribution limit. We're roughly $2,000 per person per year. But if you start very young, you can start to accumulate a portfolio of funds that are allowed to be used tax-deferred or tax-free for education in a traditional academic sense, meaning that the student can actually use that to pay for classes and pay for school. So, using actual ownership of real estate and buying real estate in that Coverdell account creates a cash flow stream for the child that they can then use to pay for school. Integrating them in the management of that then allows them to also develop the life skills necessary to continue to grow and build intergenerational wealth. Of course, opportunity is a big one. Those are the financial resources you can pass on through those types of Coverdell accounts. And the relationships. If any of you are newer to real estate investing, you know how hard it is to find a good team, a good fulfillment team, a good CPA, a good custodian. And as you are putting those relationships in place, that will be invaluable to pass on to your children and grandchildren. So going into a little more depth here on the tools for the second generation, I mentioned Coverdell accounts. Another type of account is a custodial account. It allows you to still be the custodian, but you can put the money in the child's best interest, and they can use that. You can use that to buy real estate. That's how I was able to start trading in stocks. My father opened a custodial account. I funded it, and I had the access to be able to make investment decisions. A huge one that not many people know can be done in real estate is a stretch IRA. With a stretch IRA, you can not only buy a property in your IRA, but when you pass that on to your beneficiary, which does not have to be a spousal beneficiary, they can leave the funds in the IRA as long as they simply pay required minimum distributions. And all of the wealth that had been accumulated in that IRA continues to grow tax-deferred or tax-free for the future generation. Numbers of my clients have created a separate IRA, because you can have more than one, but they intend and they name their grandchild on as the beneficiary, which is maybe a separate amount of money, a special $50,000 or $20,000 set aside for each grandchild, that that grandchild can then use as a stretch IRA and continue to have those tax-deferred benefits on. Another really neat trick is the gift tax exclusion, or the gift tax exclusion with leverage. In that scenario, what you're going to be doing is buying a property and maybe giving 20% of that to a child or a grandchild or great-grandchild. And then you take out the loan for your portion of ownership just in your name. So you have no cash in the property. So I'm sorry, I skipped a step. You buy the property cash. You take a cash-out loan, and now they own 20% of the building, and you just have the debt. Each successive year, you can gift an appropriate portion of that property to your heirs and reduce the debt amount without having to pay taxes on that. I'm not going to go into a ton of depths on how that works, but if buying a property in tandem with an heir and passing that on intergenerationally is of interest, we can certainly talk more about that later. It's a planning tool that has to be used with a lot of foresight, because it takes 5 or 10 years to fully transfer that asset, but it can be done. The 1031s also are an effective way to accumulate the wealth, and then when you pass that asset on to the heir, there's a step up on the cost basis, so there's no taxes on that deferred gain. It's a pretty powerful tool. Anytime working with real estate, though, outside of perhaps an IRA account, you're going to also want to make sure you have a proper amount of life insurance, because there will be some tax liability, and we never want to force our heirs into a situation where they will be forced to fire sell a piece of real estate for maybe at a discounted price to be able to make the tax liability. So I'm not a huge fan of insurance, but that is a situation in which proper insurance planning is very important and part of creating a long-term wealth strategy. Also creating AB trusts with real estate, where you separate the assets, where there's a trust for the wife and a trust for the husband, and this allows you to skip a generation in your estate planning and take advantage of the $5 million exclusion rules on the tax liability, or on the estate tax liability. We certainly work with attorneys and can refer to attorneys if you're looking at facing $5 million or more in assets, which is amazing actually how quickly that can add up. If you're looking at facing that situation, you may want to think about creating an AB trust and putting real estate inside those trusts. You can write rules into that allow you to continue to live in a home until you pass away, but the ownership transfers a generation, which protects in terms of taxes and estate planning rules. The third generation, grandkids, and when I first became an investment advisor, I was told by my mentor, never talk to your clients about how to give their money to their children. By the time their children are grown up, the parents don't want to give them any more money. Always talk about the grandchildren. And while it's not 100% true, I think there is a special part of a heart that gets activated when you get to hug your grandchildren for the first time. And for people who have grandchildren or people who don't have grandchildren, there is still a third generation, or what I call legacy planning component. Again, those AB trusts can be very helpful in in that type of approach, but you can also do gifts and endowments, and here's where I brought up and mentioned the life insurance. When you're looking at jumping a generation, you want to be sure you're not going to create an estate tax liability issue. For people who don't have children or grandchildren but want to create a financial legacy, or even people who do have children and grandchildren but want to do more for the world at large, charitable remainder trusts are an amazing way to use real estate and create cash flow for you now while leaving a nice sizable endowment to a nonprofit or multiple nonprofits. Charitable remainder trust can be used, let's say you've got $1 million property paid off, but that's really what you've got. That's your whole estate. You don't have a lot of cash coming off of any other investments and maybe a small pension or Social Security payment for as long as those are going to continue to last. But you've got this as asset, and you don't want to sell it. It's your home, and you've lived in it forever. You can actually create a charitable remainder trust, which allows you to donate the asset to a nonprofit of your choosing, and in exchange, receive income from that property for life, almost like an annuity. And then when you pass away, that asset transfers to the nonprofit. There are some major tax benefits of that as well. This also does not have to be done on a property you live in. It can be done with an investment property. If you're looking to harvest or create some tax offsets, you can certainly look at using a charitable remainder trust to do so. So that's some ideas to get you thinking. I didn't go into a lot of depth on any of them, but just threw out some good ideas to consider. And if you do want to go more into depth, you can contact me either via email or that's my direct cell phone line, and we can go over some different strategies and plans that can custom fit what you're looking to achieve for yourself and for your family.
That's awesome. Thank you, Kira. All right, so we definitely had a ton of questions, a ton of information thrown out there, and if anybody has any questions, we're going to take some time right now, and I can throw them out to Kira, and she can answer them as they come in. Unfortunately, we like to have one of our IRA strategists on the call with us tonight to answer some more technical IRA questions, but they are at a big event in Michigan this evening presenting for us as well. So we did have one question come over, so it is, how does inheritable IRAs fit into your model, Kira?
When you say inheritable IRAs, are you talking about the stretch IRA?
I'm assuming so.
Okay, so yeah, so if you're looking to create an IRA that you can then pass on and stretch to the next generation, there's a couple things you want to be mindful of when you buy the real estate. One is it's going to be very similar. They require an RMD, like on a traditional IRA. There's a required minimum distribution. So if I'm 20 years old and I inherit an IRA from my grandmother or grandfather, I will have to immediately begin to make a required minimum distribution. So in order to use a stretch or inheritable IRA with real estate, we're going to have to find you a property that creates enough cash flow to meet or exceed that RMD requirement. That's pretty much the most critical component, is that when we buy that property, we have to know that we have to kind of pre-calculate, and we can do some pretty solid estimates of what those RMD requirements are going to be based on who you want to leave that inheritable IRA to. And then we have to go and find properties that are going to create that. The other thing is that when we do a stretch IRA plan, we usually want to put more than just one cash flowing property in it, again, so that there's the ability and the flexibility to generate the cash that's needed to meet the RMDs. So you might want to supplement that and have both a rental property and a flip or something like that else in there that if that you're selling that's constantly creating access to cash to meet those RMD requirements, so you're not forced to liquidate the larger asset.
Great. We got a couple more coming through as well. So what is the minimum investment required to invest either through notes or ownership?
Yeah, I get that question a lot, and I kind of skirt around it, to be honest. Our technical minimum is going to be anywhere from $15,000 to $25,000, depending on the vehicle you use. So that's the lowest amount that you can start with to get invested, and everyone has to start somewhere. Realistically, this is one of those markets where to be able to get the most value, I usually recommend people looking at starting at around 100,000. But again, that's not the technical requirement, and people can start at any point at that 15,000 and above. But to really, if you're looking at how much of your portfolio to earmark, you're going to want to stay around that 100,000 mark to start.
Gotcha. Thanks. So the next one is, can you borrow in a self-directed IRA or only pay cash for a property, and what is the tax difference between the two?
So yes, you can borrow with a self-directed IRA. The self-directed IRA can be the down payment for the property, and the self-directed IRA also has to have enough money in it to make the interest payments and all of that. It all has to come out of the IRA. You can't supplement that with personal dollars. What it's called is a non-recourse loan. So you can leverage up. There are some limitations. It's not as easy as traditional leverage. Usually you have to have a higher amount of capital in the property. So to take a $100,000 example, you might be able to put $10,000 down to buy a $100,000 investment property with leverage. If you're using your IRA, you might have to put $40,000 down to be able to leverage. But you can leverage, and in terms of tax consequences, if it's structured correctly, there really aren't any. The interest is paid by the IRA, and the proceeds go right back into the IRA, and it really functions still as a set-aside tax entity. Now, again, I give the caveat, that's based on my experience and what I've seen. If you're actually considering making that investment, we'd want to get your tax professional involved because there may be some subtleties of your situation that could trigger a unique event.
Okay, so we have a question that they had actually spoke with a colleague of yours, and they were informed that Equity Build is no longer doing rehab deals with a 60-40 profit split. He said that you can invest as a lender and earn a return on money but not participate in any profit. He was wondering if you could please elaborate on those changes.
Sure, I'd be happy to. Yeah, I think I mentioned earlier, when you partner with a company, you want to make sure they're always being mindful of how to structure things in a way that's going to have your interests protected. And that's one of the things we're very committed to doing. So we reviewed our model, and I don't know if you guys looked at the website before, but if you saw on the website, most of our 60-40 splits basically worked out to a 10% return per property for the investor, sometimes slightly higher. And we switched this over to the lending model for three primary reasons. I'd say the first reason is that it's going to protect you. It puts the onus to get the flip done in a timely manner back on us. Because in the old model, if it took us 7, 8, 9 months, you were getting a lesser return. In the new model, we pay an extension penalty, so to speak, on the loan, and so you're never going to make any less than a 20% APR. So it puts the risk where it really should have been to begin with on us. Two, the lending model allows you to use an IRA without having to be concerned about UBIT, unrelated business income tax. In the flip model, there's varying opinions about how many flips a year you can do before you have to pay UBIT, which is a pretty steep tax. With the lending model, you can lend as many times a year as you want without having to be concerned about that. So that was the second major reason. And then the third reason was kind of more practical, and it had to do with utilities. We were creating an LLC for each investment opportunity, and when we went to turn the utilities on, because it was a brand new LLC, we were paying ridiculous deposits, and because it was a commercial enterprise, we were paying $500 deposits on every utility we turned on for each property, which got to be kind of crazy in terms of locking up cash flow. So now with the lending model, the property is in Equity Build's name, and we can turn on utilities without a deposit because we're a long-established company. So there were a number of practical reasons that drove us in that direction. Effectively, we were really committed to keeping your effective return the same. So that 10% is a guaranteed return, and we have prepayment penalties in the first 6 months. So in months 1, 2, 3, 4, if that property sells, you will still make 10% return anywhere up through month 6. And if it keeps going beyond that, you're going to continue to make that 20% APR. So if we flip a property fast, that's great. You could lend another time, and still potentially have 2.5 or 3 flips a year and lend on those flips. But if it takes longer, you no longer are bearing the risk of that.
All right. So if someone is new to investing, where do you recommend that a novice start on this path to building intergenerational wealth, especially if you're starting off with $50K?
Yeah. I don't want to cop out on the question, but I'm going to go back to what I said before, which is we start with the client. So I'll answer it generically, but I'm going to give this caveat, which is it's important to talk with a real estate advisor and see if that generic approach actually works in your situation or if there's some other thing that might be better. But speaking generically, our best model to get started in would be lending on the flips. It's going to accumulate capital the fastest, and as long as you're not needing immediate cash flow, it's a great way to build up that initial capital to be able to buy your first multifamily property. In terms of long-term wealth building, it's those larger multifamily properties that are going to create family wealth. But to get to that level, I would suggest starting with the flips.
Gotcha. So you presented a number of financial and legal mechanisms that I would like to get familiar with. Can you post your notes, or do you have any reading material available on the subjects that you presented?
I'm here. I'm just thinking. I could probably put together a reading list. I think if you remember my first slide, it started out saying I was an insomniac. I've stayed up till 5 a.m. 2 nights this week and gotten up at 8 the next morning. And I spend a lot of that time, reading and studying. So I don't have a short list, and I haven't condensed anything into some sort of study guide. But I would be happy to, if you email or call me, I'd be happy to put together a list of what I have found to be the most useful resources and point you in the right direction.
Yeah, what I've found is a lot of the times on these calls we get a lot of questions that really require more one-on-one stuff, but I think it's just because we do have such great information that you're giving to everybody. So I'm going to keep going because the questions keep coming. Somebody would like to know some quick thoughts on investing in tax liens.
Ooh, I love tax liens. I actually moved to Colorado because it's one of the best tax lien states. So I live in Colorado now. So we don't actually do tax liens at Equity Build, and what I know is only kind of from my own investing, but they are a great investment opportunity. What I do, I'll just share personally. I put about 2% of my annual investment dollars in tax liens. I go to the auctions here in Colorado in October of every year, and I'll take whatever that amount is, and I'll buy tax liens. And there are some subtleties and things you need to know about. What I would actually recommend is I can connect you up with a colleague that I actually use to do my tax lien investing. I'm hands-on, and like I said, I'm cynical, so I always go the first time or two myself and see how it's done. But then I'm smart enough to know I can't do everything, so I find someone I like and I pass it on. So I can connect you up with someone who does that. If you're interested, certainly.
Okay, and what is the percentage of down payment versus the purchase price?
As a rule of thumb, your down payment cost is going to be around 10%, and then your financing cost is going to be around another 10%. So you're going to come to the table with 20%, but that's going to include all of your financing, all of your closing costs, and your down payment.
Gotcha. And how are you guys determining which properties to purchase and rehab?
Yeah, again, I can give kind of a surface level answer on that. We started with a macro analysis of different target areas. So all of our investment properties right now are in Chicago. We fundamentally believe that is the best market to be in right now. But we are always looking at other markets. I mean, as I mentioned, I've invested internationally. I've got property in multiple different countries and multiple different states, and there are lots of good opportunities. But we're looking for a market that is, one, scalable, because we deal with so many investors, We're putting 200 offers a week. And so we want a market that we can get into and get lots of offers in and get lots of properties. And Chicago is that. I mean, there were 200,000 foreclosures last year. So there's lots of inventory. So that's one thing that's important. Another thing that's important is that there is a market asymmetry that we can solve. We want to find a puzzle that we can fix. And the puzzle that we can fix in Chicago is that these communities are very committed, very passionate community members. People grow up in their area. They stay in their area. They love their area. There are people there with very good six-figure jobs. But there's not a lot of cash in these communities. And so nobody is coming in and buying these old homes, fixing them up to be beautiful, and then selling them. There really isn't a lot of competition, which is another magic variable. So we go in and we, with the resources and the finances, we're able to pick an area that we could buy most of the homes on the street or on the block and turn a neighborhood that's maybe on the fringe into a very, very good area or a better area. And we go in and we can finance that property. Now, once it's fixed up and it's nice, those good qualified borrowers can get an FHA loan with 3% down and move into the property. But in the condition it's in when we buy it, in a distressed condition, there's no buyers in the area who have the cash to do what we do. So we're able to fix a market asymmetry. And that's what we're always looking for, is a problem we can solve that's going to make a difference for people.
Okay, and what if an equity build client brings the property to you guys? How does that differ from just being an investor or a lender?
Yeah, we don't generally do that. And the reason is that it's taking years. I mean, our founder started in 1984. We've been working with investors since 2005. It's taken a long time to refine our systems. And our systems go from finding the property to getting it rehabbed and building the wealth. And every time we've tried to wiggle with that, it gets really complicated. And it ends up taking a lot more time and energy than it's usually worth. That's not to say we're 100% wholesale against it. And again, every situation is considered specifically. But in general, you know, we have our own sources for our properties, and we tend to stay with that.
Gotcha. And what is your opinion on the rising mortgage rate, interest rates, and how does this affect your three models of investing?
Oh, that's funny. I just had someone else ask me that yesterday. My opinion is that mortgage rates will always go up and down. We were investing in the 80s when, if anyone remembers, they were getting 10% 10% CDs and paying 14 and 15% mortgage rates. We're nowhere near that. And you know, we were investing when interest rates were 2% and nobody was lending. My opinion is I think that it's probably going to be overall good for our economy that interest rates start to eke back up. I know I can't wait to actually make 1% or 2% on my money market again. It probably won't affect our model very much. What will affect our model is, and for the better, is when lending guidelines start to loosen up again. You know, when you as an investor can get 10 investment properties instead of 4, or when a self-employed person, a lot of our clients are self-employed, when a self-employed person has an easier time getting a mortgage, those things are going to help, and I think we are headed in that direction as the economy recovers. But as far as the hard money interest rates, I don't see that having too much of an impact because that niche of financing, the acquisition and construction costs, is not going to go away. So it's not really tied to sort of your LIBOR or your overnight Fed rate.
Okay, and if somebody has $70,000 in a self-directed IRA, what amount would you recommend to be invested in this type of investment?
70,000. It's hard to say because it really has to be considered in the whole big picture. So if all you have is 70,000 in your IRA, yeah, you probably don't want to invest 70,000 into real estate. You know, you want to keep some in cash. You want to diversify that out a little bit. But if your IRA is one account and you've got a fully funded 401k and you know cash stuck aside for 6 months and all of that, well then no kidding, you could really consider putting the full 70,000 in, maybe half into the flip lending and half into the monthly interest lending. I mean, we can tailor something like that, but it'll depend on the greater context.
Gotcha. And how do you decide the interest rate to pay at 20%?
We worked backwards from what our flips had been historically doing since we launched the model. So when we had the 60-40 split model, we looked at what was consistently being generated, and we didn't want to take any money out of the investor's pocket just because we changed the model. So that's what we did. We took the average and we used that.
Gotcha. And somebody had also asked that they're concerned with budgetary problems in Illinois and would like to know your opinion on how this impacts the Chicago area investments, as well as the high crime rates in Chicago as well.
Yep. I'll speak first to the budgetary concerns. Those are definitely real. Illinois, what keeps a lot of investors out is high taxes that no one can figure out where they're going anyway. But it doesn't tend to have a direct impact. I mean, I think if we ended up like a Detroit where we have a full default rate, the biggest impact is going to be that people will be scared to invest in our area. But I mean, even when California was paying taxes with IOUs, or tax returns with IOUs, people were still buying houses in California. And the area in which we invest in Chicago is right there by the lakefront. It's a beautiful area that I think is going to continue to become more beautiful. It also happens to be the home of President Obama. So I think that there are a lot of fail-safes and a lot of eyes being watchful and protective of that particular area of Chicago. I think that also relates to the crime situation. There is definitely high crime in Chicago. I'm not going to pretend that that's not the case. In fact, I had a conversation today with a potential client who called it a war zone, which I thought it's not quite that bad, but there is crime. What we focus on, and it's part of actually our measure, and I was telling him, we don't invest in places that have liquor store, check to cash right around the corner. We're looking for places that have parks, schools, and churches. So we're focusing on that. And we're also, I own investments there. I personally won't invest in a place that I can't, go at night and collect the rents. I heard another client tell me, the same thing. He said, he won't invest in a place his wife can't go at night and collect the rents. That's kind of a rule of thumb we use, is that someone like myself could go to that property and feel comfortable. In fact, when I'm in Chicago, I definitely, feel perfectly comfortable in the areas where we're investing.
Awesome. Well, we seem to, the questions have kind of slowed up here, so I'm going to go ahead and wrap it up here. I do want to say thanks to everybody for joining us here tonight. Again, when Kira had mentioned this webinar topic to us, we knew that we had to get it on because it would be perfect for our audience and that you guys would be really engaged in it, which you have been. So I want to say thank you to both Kira for presenting the great topic as well as our audience for really providing some great dialogue and questions. We did get a lot of questions regarding a recorded version of our call. It will be available on iPlanGroup.com, and you can view it right from the website there. If you'd like a copy of it for yourself, feel free to email invest@iPlanGroup.com, and I'll send you a link to a Dropbox, and you can download the file for yourself so you can watch it whenever you'd like. And once again, I just want to say thanks for joining us. Kira, if there's anything you'd like to say parting here, I hope everybody enjoyed the call, and we'll see you next week.
No, thank you very much for the opportunity. I appreciate it, and we really appreciate working with you guys. You're a great partner.
Great. All right. Once again, everybody, thanks again. We'll talk to you next week.